Hey, everybody, welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we've got Justin Smith on the pod. He is the managing director and head of business development at Agellus Capital. Agellus Capital was literally started back in March of 2024, so it's only about 9 months old, but they have already landed their first platform deal, and their investment thesis is going after the home and business services sectors, which is a very hot and popular sector of kind of the private equity space right now. Justin was brought in to build out a business development team, which he's done multiple times at other private equity firms. So this is a very interesting conversation where we talk a lot about deal flow, how he's going to market and essentially finding potential deals for Agellus to acquire. So we talk about the structure, we talk about the challenges within the BD world, within private equity, and then we think about kind of what's going to happen in 2025 as it relates to deal flow. So it's a very interesting podcast. So let's get Justin on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Justin, welcome to the podcast. Thanks for being on.
Thanks for having me.
Well, it's easy to remember your name because obviously with the same first name, but let's jump right in here a little bit. Give maybe the audience a little bit of an overview of who you are, what you're up to, and where you are.
Yeah, so Justin Smith, Managing Director and Head of Business Development at Agellus Capital here in Clayton, Missouri, just outside of St. Louis. We're a 9-month-old private equity firm investing in lower middle market and middle market essential services businesses. And the two founders spun out of two larger private equity firms earlier this year, Audax in Boston and Thompson Street Capital here across the street in St. Louis, to really take best practices from 15 years of their investing in the middle market to apply to Agellus. We've been at it now 9 months, having a lot of fun. Got our first platform close earlier this summer, have 5 under LOI. So it'll be a busy December for us here at the firm, but we're having a lot of fun and just getting started. So big plans for us in the future and a lot of work in front of us.
Interesting. How did you kind of team up with Agellus? And it's interesting, I've never had anybody on that's literally the PE firm has literally been birthed in the last, year. So if you wouldn't mind and kind of share a little bit about maybe, obviously you're not one of the two people that brought it in, but like, how did they have the idea to join forces? And then how did you get kind of brought into the fold?
Totally. So the two founders are best friends.
Okay.
They met at Audax 15 years ago as colleagues.
Okay.
Jeff then later left 3 years after starting at Audax and went to grad school, then came down to St. Louis to start his career at Thompson Street. They stayed close throughout, were best friends, best men in one another's weddings, goddaughter and father to one another's children, and decided to start this firm in March of this year. I got a call from Jeff right around that time, actually earlier in the year, which was a cold reach out. He said, "Hey, I see what you're doing online. I see you're in the business development trade. You've been doing it for a while. Tell me your story. I'll tell you mine." And he was looking to build out the firm, beginning with the BD function, which in and of itself was appealing to me because I like being a part of a team that really values this division. We had a few conversations. The rest was history. I said, "Where do I sign?" And ended up joining Agellus in right around the March-April timeframe. We hit the ground running to raise our first fund, which was completed 4 months after launch. So we raised a $400 million buyout debut fund, which is the hard cap for investment. Have about a dozen LPs in that fund that we're really proud of. And we're looking to invest in about 5 to 7 platforms in this first fund, again, targeting that essential non-discretionary services sector. So we'll invest with companies as small as 2 to 3 million of EBITDA, up to 20 to 25, as long as they have a few themes that are really incumbent upon our investment thesis, such as large TAMs, hyper fragmented markets, strong recurring revenue, and non-discretionary service offerings that are ripe for a buy and build M&A roll up. That is our playbook. That's what we look for. So having a lot of fun.
It sounds like, I mean, you guys accomplished a lot in the last, 9 months or so. I guess a few things that I want to kind of just unpack a little bit, I guess, what were some of the challenges kind of going into a brand new private equity firm, because obviously I was looking back at your profile and you've been at a few other PE firms that I'm guessing were more mature in age than kind of baby when you started at, right when it literally launched. I guess what were some of the things that were challenging kind of as you started in Agellus?
It was ironic, Justin, that the prior two firms were either brand new or brand new to BD. So that's kind of the beauty of it. I get to recreate the wheel now for a third time.
Yeah.
Come into a fund and build out a BD function from scratch. I kind of first stumbled into private equity back in 2013 in Houston with an energy fund called Atomic Capital. I was the first person on the team there as well. And over 8 years, built out a large fund as well as a BD function specifically to acquire energy assets. Did the same thing later at a fund called Longwater in Dallas. Spent a little under 3 years there. They were a seasoned fund, but I was building out the BD function for them from scratch as well. And then took all of those learnings here to Agellus, and are basically taking best practices from everything learned over the last 12 years to do it here on a larger scale. The challenges, to answer your question, are this market is hyper competitive right now, specifically in services sectors, blue and white collar services, home services, specialty distribution. So to really have a right to win, or even I should say a right to participate in banked deals in this market, you've got to be aggressive with your outreach and have name recognition. So the biggest challenge for me this year has been building the Agellus footprint in the market and letting people know what we're about. And thankfully, the track record of my colleagues and our two co-founders have really helped accelerate that. But that by far has been the biggest challenge, telling people who we are, letting people know about our experience so we can jump in the game and participate to win deals in the sectors that we are targeting.
And I guess from a brand and outreach perspective, like how are you kind of trying to tell the story that, yes, the firm is new, but obviously your founders and even, other people that are part of the firm have track record. And so while Agellus is a new brand, you have the ability to, leverage your years of experience that, are older than just the March of 2024, essentially.
Yeah, so the truth is we really lean on the partner's experience and their track record there. So I open a lot of conversations by saying we're an 8-month-old, 9-month-old private equity firm that spun out of Audax or Thompson Street Capital. And then talk about some of the deals that the founders did there. For example, our co-founder Jeff from Thompson Street did one of the first roll-ups in residential plumbing with Lynn the plumber. That's a Harvard case study style M&A roll up for residential home services. He did another one with a business called Pestco. Same style of investment there. The list goes on and on. Bo did stuff in commercial landscaping, in food and bev distribution, and related verticals. So there's been a lot of successes that we can talk to help get bankers excited about wanting to do deals with us based on those experiences in the past.
Yeah. I've talked to a few companies on the pod and off the pod that are kind of in this home services, business services space. I guess what's the most attractive thing to PE about it? Is it part of the fragmentation that's going on? And obviously that's getting less and less so with more and more PE coming into it. But like, what are maybe some of the key areas that obviously they've seen success in? And obviously there's a lot of private equity, both mature and startup private equity, if you will, that are diving into this, home and business services kind of space.
It's all about the TAM and the market fragmentation, right? So IT services is the first sector we invested in. It's not home services, but it shares many of the same dynamics. It's a $50 billion TAM, total addressable market in North America, with thousands of companies in the sector, many of which are very small. So you can buy one platform, acquire that management team, acquire those folks, work with them, and then get a dozen more, 5, 10, and tuck those in to build a national market leader with an integrated service offering that will ultimately trade at a premium to your entry multiple. It works for home services. It works for professional services. As long as you have a large addressable market and fragmentation in that industry, then it can be rolled up. And that's what a lot of firms do. I would also add, you don't have to be the first one to do it. Being the one with the first idea to go do a plumbing roll up or an HVAC or ITMSP, these markets are big enough that you can copycat. You can do what other folks are doing. There's enough room for everyone as long as you do it the right way.
Yeah. Can you talk about, or maybe share some like lessons learned about building business development teams and functions within the private equity world? I've known a few private equity firms that I work with that they've done just that over the last probably 12 to 24 months. They've really invested in their internal, business development engine. So I'm seeing it be more and more popular, especially, a lot of the big companies already have it, but some of the small and mid-sized PE are starting to, really see the value in building their own internal BD engine versus relying on, just talking to intermediaries and things like that. So I guess what was the selling point to you? Because obviously it sounded like it was an easy recruitment call for them to call you and say, hey, this is what we want to do. So maybe share some of that best practices and why private equity is really doubling down on BD.
Great question. I don't think you can raise an institutional equity fund in today's market as a private equity firm without a dedicated BD function. That might be a provocative statement to some people, but that's my experience. This market is very competitive, specifically if you're investing in A assets in sectors like business services, for example. You need dedicated professionals on the ground daily, spreading your investment thesis to the market, building relationships, and bringing in deal flow. The days of having a deal professional cranking out an LBO model and just picking up the phone to call a banker are over. You have to have a dedicated BD team because there's an imbalance between dollars chasing deals and deals to be chased in this market. And that's been the case for a few years now. So it's kind of the gilded age for BD in that funds now recognize the value. They're investing in the resource. They're investing in the divisions. And you see it on the road. I mean, these ACG and the M&A circuit, they're more packed than ever. Bankers' calendars are busier than ever, taking calls from folks like myself to learn about what's in the pipeline and get up to speed on different market trends in certain sectors. So BD is very much in demand for all the right reasons. We are the tip of the spear for private equity, and we bring in the deal flow that is needed to ultimately execute and invest capital.
Yeah. And kind of thinking about the funnel of BD and obviously maybe talk about some of the channels where deals come from, right? And so, if you've got 100 deals coming into the top of the funnel, what percentage are coming from, the traditional banker channels versus going direct to seller? And are you going direct to seller, I guess, is another question.
On occasions, we will. Some will. It depends on the way your fund is built, right? We're looking to invest in 5 to 7 platforms with $400 million worth of equity. So on average, we're going to be writing larger checks.
Right.
And so we tend to lean into banker relationships. But we still have relationships with other sorts of intermediaries where we can source deal flow. So business brokers in regional markets that don't have a national footprint. We work a lot with buy-side brokers who bring unbanked businesses to the table that are looking for investment partners. That's valuable. And then we will do some proprietary outreach on occasion. But 80% of my time is spent building relationships with the top 25 to 30 investment banks that are doing deals in our target verticals. And if you have a good investment thesis, I would say you shouldn't be afraid to participate in those bank auctions, pay what it takes to win that A asset, and then do your work after the fact to acquire add-ons, blend down the multiple, integrate a platform with those add-ons, et cetera.
Interesting. So you're kind of looking at this because maybe the check sizes are bigger. A lot of the companies that you're going to be targeting anyway are going to have a bank if they're going to be open to selling versus, somebody that's going in the lower middle market that, maybe they're looking at, half a million to $1 million of EBITDA. And, maybe it's a little bit more of a mom and pop where they may be open to a direct outreach versus a, 10 million EBITDA company. Is that kind of fair? Is that the way you think about it?
Yeah, if you're $100 million fund with a small team, then and you're doing deals around the 3 to 5 million of EBITDA range, you can insource that outreach and you can reach out to founders every day and find attractive investment opportunities that are outside of a bank's process. It's harder to scale that approach with a 4, 5, $600 million fund. There's value to it. Some firms do it really well. I think that what works best for each firm is dependent on their investment strategy and the size of their fund. And I think a mixture of all the above is ideally the best approach for most groups.
Yeah.
If that's
And
helpful.
absolutely. And I think when you build out your team, like what's the structure look like for you? Obviously, I'm guessing you've got a few layers of BD talent on your team, but maybe talk through what it maybe look like now and maybe what it could look like, as the firm and the fund continues to grow.
Sure. We've got 3 divisions here at Agellis. We have business development, we have the deal team, and we have strat ops, which other firms would call operations.
Yep.
ED is self-explanatory. I oversee origination, bringing deals in, getting them past that first line of defense over to the deal team. The deal team executes and closes deals. And then the operations team works with our portfolio companies to optimize the platforms, find talent, and help them establish internal capabilities to integrate add-ons, which is a cornerstone of our strategy, right? We'd like to do a handful of add-ons per platform per year to scale what starts out as a $10 million EBITDA asset or so up to 40, 50 plus $1 million EBITDA national market player. So that strat ops team is pivotal. And as we grow, we want all 3 divisions to grow. And ideally, in 7 to 10 years from now, we're $1 billion+ fund if we do a good job with 50 plus on the roster throughout those 3 divisions, and maybe another division for ancillary tasks like debt capital markets and things like that to manage advisory relationships.
And you might have mentioned this, and I may have missed it, but part of your criteria, are you taking majority stakes in these companies or minority deals? Like, what's your leverage on that or buyout?
Yeah, everything we do is a majority control investment.
Okay.
That being said, we're partnering with management teams that are often staying in and giving meaningful input every day, running the businesses in a lot of instances. So on paper, we're controlled, but it's more collaborative. Like we're definitely working with them and taking guidance where appropriate to help grow these platforms.
Yeah, I was going to ask about, a lot of times when you take majority control, sometimes the founders are, exiting for a reason or, looking at private equity for a reason. Maybe they want to shift into not being the business owner and doing everything. And they maybe want to shift into a specific role within the business or they want to exit, right? So I guess as you think about looking at a deal, I'm guessing, and I shouldn't guess, but it is having a strong current management team that wants to and has the ability to grow with the investment. That's your ideal scenario, as opposed to, having to chop and change the leadership team, post acquisition.
Great question. Generally speaking, yes. If you're acquiring a platform investment that you want to build around, you need a management team in place that you can trust and you think has the chops to scale from where you are, call it 5 to 10, up to the 30, 40, 50. Mm-hmm. If you're acquiring an add-on, that's where it gets more interesting because every add-on is going to have a founder and a management team with different skill sets, different market relationships. So you have to figure out how to piece those puzzles together. You could have a founder who's an add-on to a larger platform who becomes a regional corp dev head. right? And you could have another one in another part of the country. Another strategy that's fairly common is to have a holdco structure where if we're acquiring a $10 million EBITDA company that we know we want to scale to 50, build the holdco on day one with a management team that already knows how to run a $50 million EBITDA business. And they work with those management teams at the add-ons and at the portfolio companies under one platform to integrate, optimize, and scale that to that $50 million plus per se sized asset. So that means you're getting a CEO on day one, ideally, not always day one, a CFO, a COO, and a corp dev head to really sit at the top of the org chart and guide strategy over that whole period to get you from point A to Z.
That's interesting. So almost the acquisitions kind of are not necessarily divisions of the holdco, but they kind of become under the kind of holdco CEO and leadership team. That's interesting. I hadn't heard that model before. That's fascinating, actually. It kind of, you create it and then you bolt on all these other things that actually are doing the work, essentially.
And it doesn't always happen on day one. It could take you a
Right.
year to find a good CFO or a corp dev person at the holdco level. And they will own a lot of that strategy themselves. We don't necessarily dictate to that platform or that holdco. We have an operations team, our StratOps team, but we aren't day-to-day operationally focused. We really lean on them and we lean on that holdco to help do the add-ons, to optimize the platform, and so on. So it's a really critical function, and those are key hires that we have to make early and really get those right.
How do you think about talent? And obviously, you're ideally looking for a target company that you're going to buy that has a strong management team that can, obviously, they grew the business, but they have the chops to continue to scale. How do you assess that, other than asking them, do you want to stay on board? Like, how do you think about evaluating a CEO or a CFO or some of the other operational leaders to say, hey, yeah, you've built a $10 million business, but sometimes what got you here won't get you there. And how do you assess and what are the mile markers maybe that you put in place to say, hey, we thought you were the right person, but maybe we're stalling here and we need to bring in a different player?
A good one. For that, we really lean on the experience of the partners who have, a decade and a half of experience doing roll-ups in this market, and specifically managing those people dynamics around growing a platform from something small into a national strategic asset. So it's a delicate process, and you don't really know on the front end if someone who's managing an $8 million EBITDA business can run a $50 million EBITDA business unless they've done it before.
Yeah.
It's an exercise that the partners will do. And often cases you have that holdco structure in place, either as formal heads of the platform on day one or in a board capacity to advise. So in the first 6 to 12 months of that hold, you can answer that question. You can't necessarily answer it on day one.
Yeah. And also I was talking to a friend of mine earlier and we were talking about talent assessments and he was saying, during the due diligence period, everybody, it's like a first date. Everybody's on their best behavior. Everybody's like, yep, we're all gung ho. And then, it takes the post acquisition honeymoon period to kind of rub off. And then you kind of figure out, okay, who is actually has the chops to go from 10 million in EBITDA to 30 to 50 kind of thing. And you can't really test it early. It's just hard to assess talent kind of during that diligence process to know who's going to be there short and long term, essentially. So,
yeah, what I would add to that, Justin, is that most management teams that are in a process looking to trade hands, so to speak, know that they need capital and leadership for the next level of growth. So they will defer to the buyer in that regard and understand that, the org chart would look different over time, right? So there's deference there for the most part. And I just say this as a disclaimer. It took a lot to get the business to that stage. So there's a lot of deference in both directions, right?
Yeah.
They defer to the sponsor. In this case, it would be us on how to take the business from 10 to 30 plus, right? And we would defer to them on how they got there and best practices. And so it's that collaboration and give and take. That's the special sauce that really helps a roll-up strategy work.
Yeah.
Over a whole period.
Yeah, no, I think that makes a ton of sense. And obviously, the more bolt-ons you get, the more experience you bring into the table, right? And so, somebody that built a business over here in this part of the country has different or interesting lessons learned that somebody else may not have, and you can kind of bring all that learning together as far as that goes. Um, Going kind of back to the BD side and just kind of the deal flow, you've been in private equity, since 2013, I think. Is that about fair?
Yeah.
So you've seen, a lot over the last 11 years. Maybe over the last maybe 4 or 5, have you seen the number of deals that need to come to the top of the funnel in order to get one deal through an acquisition? Is that number increased, or how do you think about, like, we need to bring an X number of leads to get one deal through? Like, I'm just kind of curious the kind of metrics you look at or think about kind of through the funnel process.
Broadly speaking, that's true. You have to see more deals because the quality of deals over the last couple of years is not there.
Mm.
There's really a bifurcated market that we're in right now. A assets in sectors like business services, for example, are trading for mid-teens multiples. It's very attractive, highly competitive sectors. Other markets like consumer products or transportation are barely trading at all.
Oh,
If they
interesting.
are, it's at significant discounts to historical valuations. That's just macroeconomic factors that cause that. And so if we're in business services, yeah, I have to see a lot more deals for us to find the winner because valuations are inflated and you're not going to win all of those at bats.
Yeah.
However, if you have an investment thesis that's targeted, you've done your homework, you know what sectors you're chasing, you can come into a process, be aggressive, and have a higher batting average there. So that's why I stress the investment thesis. It's something we spend a lot of time on. Not being an opportunistic, agnostic firm that's just saying, yeah, we get this at 6 times, we love it.
Right.
No, you don't be afraid to pay a double-digit multiple if you've done the homework, you know the sector, and you have the playbook to add the value post-close. That's kind of the way we think about it.
Yeah, if you have a good buy box and you stay within it and you're a very disciplined investor, then you can easily say no to something that other people may be like, "Oh, I would do that." Right? But if you're like, "Hey, that's not our wheelhouse, not our expertise," you're willing to pass up a deal that may look attractive to somebody else because you know that you may not be able to execute as well as somebody else will because you've got this very targeted, very focused investment thesis that if you find something in that buy box, you may overpay compared to somebody else, but for you, it's not overpaying because you're going to get that. You're going to be able to hit that out of the park, essentially. So that was going to
Yeah.
be one of my other questions is around the valuations. I've heard that very consistently that it seems like the delta between what sellers are expecting and what private equity are valuing these business at has definitely the delta has started to shrink a little bit. It's definitely not back to where deals are transacting a lot, but I'm guessing you've seen the same things where the valuations have started to not normalize, but come a little closer to what PE thinks is real.
Totally. There's a handful of factors at play here. Valuations have normalized from COVID levels, right?
Mm.
Where that was a funky period in history that, we don't have to get into. But what's driving up valuations right now is the imbalance between capital and deals. There aren't a lot of quality deals in market right now, but there's a lot of capital that has to be deployed. And you have large cap funds creeping down into the middle market and the lower middle market, driving up multiples. I read a report recently that a lot of large cap funds now are underwriting their fund returns at 17 to 20% IRRs, which is materially lower than historical averages. So the more competition in the market, the more dollars chasing deals inflates multiples in certain sectors, makes everyone's job harder. No one more so than mine, which I like because that means you get to go out there and sing for your supper and bring more deal flow to the table so you can have the same standards with an investment opportunity despite heightened competition.
Interesting. So you're saying that it's kind of like supply and demand. There's a lot of capital that once it needs to be deployed because it was raised a year or so ago, but there's not enough good deals to deploy that capital. So obviously you don't want to deploy that capital into a subpar deal. You want to make sure that you're deploying it into something that's actually going to return something to your investors. So that's kind of the mismatch is there's not enough deal flow, but there's a lot of capital that needs to be deployed. Is that kind of what you're saying?
Yes, and that theme permeates all the way to the top of the food chain, where
Mm.
large asset managers that invest in companies like Agilus will tell you, we're going to cap your fund at this amount. We'll invest in you as long as you commit to a fund that's no bigger than this, because if you get too big, you're going to you're going to be forced to deploy just to get that capital out the door. But we know as the asset managers, the deal quality is not there. That's good enough for you to deploy in a reasonable time frame to deploy an amount of larger than X. So it's a real phenomenon out there that a lot of funds are having to navigate.
That's interesting. So you're raising from large institutions, and they're saying we're not going to give you. We want you to cap your fund at X because, to your point, if you raise too much, you're going to be at a point where you're not having enough deal flow, and you're going to put my money into a bad deal or a not as good deal, and I don't want you to do that. Effectively, that's kind of like what they're saying.
Exactly. Or overpay for an
Right.
overpay for a B asset or buy a bad asset you shouldn't have because of the pressure to deploy.
Yeah, got it. Well, we're recording this pod, in December of 2024. So we're post-election. I guess, a lot of times, you're in December, you start thinking about the new year and goals and what's going to happen, and everything's rosy and great. I guess, if we recorded a podcast a year from now, what do you think happens in 2025? Just macro. I don't need to get nitty gritty necessarily, but where do you think deal flow ticks up in 25? Do you think that there's an opportunity to get good deals? Like, what is your kind of thesis or outlook on 2025?
Yeah, so if you think back of this year, deal flow is modeled to be up around 30% year over year from last year.
Okay.
Last year was atrocious. So that's not a great benchmark, but it's improved. We think it will continue to improve. The interest rate environment's improving. Uh, the new regime in the White House, not to get political, is just does not have private equity in the crosshairs
Yeah.
as the current one does. So there could be favorable tax structures and just a less a more favorable regulatory environment, I should say.
Yep.
Um, and then in terms of deal dynamics, yeah, we think deal flow will be up. Hopefully valuations can normalize. Certain sectors may struggle with the new regulatory regime. If you think about home services and a lot of the labor in certain parts of the
Mm.
country that performs that work, there could be labor issues around I-9 and E-Verify and things like that. So construction, I would be skeptical of. Certain home services verticals that are currently hot, like commercial roofing or landscaping, it'll be interesting to watch how those start to trade as some of these regulations come down the pipe. But then in the traditional core verticals that we spend time, business services, white and blue collar, some home services, specialty distribution, we're broadly optimistic and think that 25 should be better than 24.
I didn't put two and two together. Even though I own a recruiting business, I didn't think about the talent piece from a regulatory and political standpoint. Like for some of these home services businesses that rely on uh, talent, right? And so how do you think about that if there is a mass deportation and that impacts your business if you have that type of workforce? I didn't really add that together. That's interesting. And definitely could impact both their ability to price themselves, right? Because obviously, if you have to pay for more expensive talent, then you've got to increase your price to the consumer, and that may challenge that business. And yeah, that's interesting. Definitely don't
Yeah,
want to get too
there'll
down
be
a
winners
rabbit
and
hole.
losers. If you're a buttoned up commercial landscaping business that has all self-performed W-2
Yeah,
employees, e-verified everything, then you can probably win market share versus some that don't and get caught up in a regulatory matter
yep,
or just lose folks. They either get deported or choose to leave, right? It could go both ways. It's a dicey space in some of these home services verticals going into the new year based on the stated goal to instantly deport 12 million people.
yeah. Interesting. I can't not talk about AI a little bit. Obviously, home services businesses are not. I like them as an investment thesis, given that they are kind of AI resistant or resilient from the standpoint that if your AC goes out, you still need somebody to come out and turn a wrench. AI can't do that yet. So I guess if you think about AI as it relates to businesses that you're looking at, but also have you in the PE world, in the BD world, leveraged any AI tools that are helping you be more efficient and find better deals or more deals without having to add, manpower just by leveraging some AI operations?
We're not at this scale as a young fund with 9, 10 employees in less than a year under our belt to really benefit from AI yet. But we understand that it's important, and we see the large cap funds doing it. I have a family member who's a partner at an AI consulting firm who works with some of the large cap funds, and I get to hear about some of the things they're doing. It will be a part of the repertoire for Agilus at some point in the future. But the time commitment and capital commitment to create an optimized AI engine for us that was really a value add is not here yet. So not available to us yet. So it's something we're thinking about, but still early in the game here. We're going to wait and see as to when it makes sense to adopt that.
Yeah. Yeah. No, I mean, it's one of those things. I've talked to a few PE and they have kind of shunned AI because obviously, they're very concerned about the data privacy. So they're not using AI to like help them do like review a deal memo or review financials or anything like that. Cause obviously that's very sensitive information. So I'm just always curious about what firms are using it for and how they're using it, if at all.
Yeah. So the best use case, Justin, what I see a lot of sponsors doing and what we would probably do is to create a large data repository. You think about all the PowerPoint presentations and decks that trade hands at a private equity firm on a given day, whether it's diligence requests or SIMs coming in on companies, having all those in a central repository and typing into your bot, what was XYZ's EBITDA in 2021? Or what are the trends across this sector based on everything we've seen in the last 4 years from our internal data set? And having that at your fingertips for internal use, I think is a best use case so far. And then later stage use cases would be more external, whether it be virtual assistants or email management, which would be great if someone could just optimize my emails and tell me everything important that hit my inbox that day.
Yeah. Yeah. Anything to kind of like minimize the kind of just constant emails that come in. But that's the other challenge is everybody's using AI to figure out how to write a better email, which they're all junk anyway, in my humble opinion. But yeah, it's interesting how people are leveraging AI because it's not going away. I feel like it's just going to continue to optimize. And I think if you use it correctly, it could be a very big, opportunity to, be a differentiator for sure. The other thing I wanted to just touch on a little bit here as we kind of wind this down, you kind of worked in kind of consulting, in a big four earlier in your career. If somebody's listening to this and maybe like, hey, I really want to get into private equity, but it's not an easy, industry to crack into, right? And so I guess maybe what are some things or tips or tricks that you could maybe provide? Like, hey, this is how I was able to transition out of, big four consulting into private equity, or, just things that people can do to, kind of break into the industry if they want to?
Great question. The short answer is take a risk on a small, young firm. Right. New private equity firms are popping up every day. They're not all created equal, but if you do your homework and find one that you think checks the right boxes and get in early, that's a pathway to success. The traditional entry point into private equity has been tier one education at a top university, a few years of investment banking, MBA, then you land at a private equity firm. But that was 10 years ago. There are so many private equity firms, 3,500 plus private equity firms in America right now that have committed funds. There's a lot of ways to get in. So don't necessarily shoot for the stars with a Blackstone or an Apollo, right? Find these small regional ones that have a $50, $100, $150 million fund, get in early there and make your mark.
Yeah, no, I think it makes sense. I think, if you don't have that kind of time or pedigree to go through the process like you just laid out, you got to figure out how to knock down the door. And sometimes it is taking a little bit of a risk, like you said, on maybe an earlier stage, fund and all of that. I think that makes sense. I really appreciate your time today. I wanted to kind of just wind us down here. I've got a 3-pack of questions that I ask every guest. And so first question is, what is the most influential business book that you've kind of read recently?
It's a book I read every year. It's called Make Your Point by Bob Elliott. As a BD professional, communication is key. And to make sure that I'm communicating effectively, not rambling and saying the right things, I read that book every year. It's a great one that I recommend to anyone who's in a market-facing speaking capacity.
I will have to check that out. I feel like I ramble sometimes, so I'll have to check that out. All right, second question. What is your favorite thing to do outside of the office?
Besides chasing toddlers, I love to play golf.
Well, that's interesting because you moved from Texas to St. Louis, and I live in Austin. You could golf today. I don't know if you can golf in St. Louis right now.
I'd be hitting on snow, but no, I couldn't. Yeah, it's a trade-off, right? I mean, I love the game. Don't get to play as much as I used to, but it's that much more enjoyable when you get out there these days.
Yeah, no, I agree. My wife's getting into golf, and so it's helpful because she'll be like, "Hey, I want to go practice," and I'm like, "Cool, let's go do it." All right, last question here. What is your favorite vacation spot?
Charleston, South Carolina. First visited in 2018. Wife and I fell in love with it. Got married there. We've been going back ever since.
Interesting.
The secret's out. A lot of people are moving there, so a little more crowded each time we go.
Yeah. Are you kind of like downtown Charleston, or you are like more along the kind of beaches and all of that, or what's your point?
All the above. We do downtown. We like Kiowa Island. We like Palmetto Bluff, Sullivan's Island. There's a lot to explore there.
A lot of good golf on Kiowa Island, from what I hear. I've not been down there, but I've had a few buddies that have done a golf trip down there, and they say it's lovely. So
definitely is.
Awesome. Well, Justin, I really appreciate the time. This has been awesome. And I appreciate your insight, especially now that you're kind of in this new fund and you guys are kind of off and running. If people want to reach out and learn more about you, learn more about Agellis, like what's the best way to get you?
Yeah, either LinkedIn or you can email me, jsmith@agellis.com. Be happy to talk shop, deals, or whatever's on your mind.
Awesome. Well, we will have all of that information in the show notes. Justin, man, really appreciate the time. It's been great to connect, and appreciate you being on the podcast.
Thank you, Justin. I enjoyed it.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.